Thank you for joining me on this video. My name is Rodney Constable. I'm the president of Simple Market Signals. And in this video, we're going to be taking a look at the difference between the S&P 500 and the Dow Jones Industrial Average. And the ticker symbols that we will be using for the analysis are SPY, that is the ETF for the S&P 500, and DIA, which is the ETF for the Dow Jones Industrial Average. And the first thing you're going to notice here, I've got the screen set for one complete year of trading. So we're looking at the last 253 trading days, and so the S&P 500 is the red line, and we can see here that over this time frame, the S&P is up 26.23%, and the Dow Jones Industrial Average is up 19.35%. Okay. The other thing that I want you to take away over this from this last year, and I'm going to back this up so you can see it over a longer time frame, but look at the correlation. And what I'm talking about is directionally that both of these, when the market turns down, both of these go down. When the market goes up, both of these go up. They go down, they go up, they go down, they go up. So that's called correlation. So the correlation effect these days is so tight amongst most asset classes that diversification over a certain point doesn't really help you too much. And here's what a lot of people don't understand is that that diversification reduces stock specific risk, but it doesn't affect systematic risk. Okay, and that'll come into play later on in the video, so please stay with me, and I would really encourage you to watch this entire video at least once, if not several times, because I'm going to give you stuff at the tail end of the video that could make a massive difference in your trading, in investing, and perhaps even in your life. And I'm not kidding, it's going to be that powerful. Okay, so with that said, let's start backing this thing up. I'm going to drag this pointer back, and what you're going to see is, right here, guys, look, this is the S&P, right, as the red line, and you can see when they both went, when they peaked, and there's the blue line, the Dow, and they both went down together. Look at how tight those correlations are, and that's what I was talking about when diversification can only do so much for you, but this drawdown here, that's systematic risk. That's the system. That's the stock market itself. And another thing to take away from this video is that when volatility increases, and volatility is also known as market risk, and the fancier way to say that is systematic risk. Okay, it's all the same thing. So volatility, market risk, systematic risk, it's three different ways to say the same thing. But when volatility increases, correlations increase. So especially within the equities markets, and that's kind of true on a global basis as well. All right, and you can go out and look on my YouTube channel for other videos on that. I will be producing more and more videos on these type of topics going forward. But the point on this right now in this video is that you see this drawdown, and look at how tightly correlated those two investments are. All right, the S&P 500, which by the way has 500, hence the name, 500 stocks in it, and the Dow Jones Industrial Average has 30 stocks in it. And I think what you're going to see here is, even though there's 470 more stocks in the S&P 500 than what we have in the Dow, it doesn't really change the direction of the investment over time. You can see here then they bottom together, right? They bottom exactly together and start bouncing up, and then you start to see here, at least recently, the S&P 500 has been outperforming the Dow. All right, and now we're going back to about 2 full years here. I'm shooting this video on February 12th of 2020, and just coincidentally, I didn't plan it this way, but right now we're looking at 2 full years of data because I've got this thing backed up to February 12th of 2018. So this is exactly 2 full years of data, and you can see directionally these two investments are almost exactly going in at the same time in the same direction. There's really not a whole lot of directional difference. There is a slight outperformance advantage, 31.19% over the last 2 years versus 24.25% for the Dow. But you can see what I'm talking about. The correlations are so similar, okay? So let's keep backing this thing up, because I really want you guys to understand this, that, and I'm going to back it up as far as I can go. But we're going to stop. I'm going to try to land right on March 9th of '09, which is the day that the market actually bottomed back in 2009 after the big downturn from tail end of '07 to March 9th of '09. So we had that big drawdown that happened. Most of it happened in 2008, but it started in 2007 and then ended in 2009. So what we're looking at here is this new secular, and here's a word for you, secular, S-E-C-U-L-A-R. Secular means the long-term trend, okay? So when you're looking at the stock market, you've got cyclical bull markets and bear markets, and you've got secular bull markets and bear markets. The secular is the really long-term trend. It's years and years and sometimes even decades. The cyclical markets happen inside of a secular, so there's a little extra stuff for you there. But so if you hear somebody talking about a secular bull market, that is a really long bull market. They generally last in the equities markets 16 to 18 years. Okay, that's historically been the case. Cyclical markets, the cyclical bulls and bears, and remember, so the cyclical bulls and bears will happen inside of a secular trend. Okay, so the secular is the really long-term time frame. The cyclical is the shorter term, and sometimes you can get counter trends. In other words, you can have a cyclical bear market inside of a secular bull market. So little extra stuff, didn't really intend to throw that in there, but I have an extensive background in finance, and I'm a geek. I love this stuff, as you can probably already tell. So hopefully you guys are enjoying this. But you can see, even going clear back to March 9th of '09, and you can see this, and hopefully you're watching this on a larger screen, because if you're watching this on a phone or something like that, it's probably going to be pretty hard to see some of these small data points. But March 9th of '09 through, and I just need to pull that forward a little bit. There we go. Through the 11th of February, so last night's close there. And you can see here that the difference, we're up 480.43% on the Dow during that time frame, and we are up 515.13% on the S&P 500. And I'm going to change this screen a little bit so you guys can see this. But again, 515.13 versus 480.43, that is the difference. A little over about 25% difference. I'm just rounding that, but about 35%, excuse me. About a 35% difference, percentage points difference in favor of the S&P 500 during this secular bull market. So it doesn't necessarily mean, and I don't want you guys to jump to conclusions. It doesn't mean that in all time frames the S&P 500 is going to outperform the Dow. So I think a lot of people these days, perhaps most people, the data would suggest, invest in the S&P 500, and that's absolutely fine. I do a lot of my own investing there, but I don't want you to jump ahead and think that in every time frame the S&P 500 is going to outperform the Dow, because that's really not going to be the case, and you'll see that as we go through this video. But the differences will be subtle, and remember, you're getting a lot more diversification. You have 500 stocks here in the S&P 500. You have 30 stocks in the Dow Jones Industrial Average. So to the degree that somebody wants diversification, the S&P 500, in this case the red box, probably would be the better choice. Okay? So, but, there's no right or wrong answer. Now, the other thing to know is that professionals, and again, I've spent 20 years plus in financial services myself. Professionals, when we do analysis, use the S&P 500 because of the fact that it is so diverse. Amateurs, no disrespect intended towards anybody, but amateurs tend to look at and talk about the Dow more than they do the S&P 500. So again, I'm not trying to be negative towards the Dow. That's not the point. I'm just letting you know that in the industry itself, industry professionals use the S&P 500 for analysis. Amateurs tend to talk about and look at the Dow, but over time, there's just not a massive difference between the two from a performance standpoint. So if you understand directionally and also percentage-wise what's happening with one, you're going to have a pretty good idea what's going on in the other, okay? So let's go back here, and again, you can see that directionally these things are locked in at the hip, Okay, there's a slight performance advantage as we've seen here over time with the S&P 500, but it's not going to be that way forever. So let's go back actually to this view, because I think as I back this up, you're going to understand. It's a little easier to see the performance differential. So you can see once we start going back and get into where we have some of the downturn, right, the 07, 08, and part of 09 downturn, the performance numbers actually start to favor the Dow. And the reason for that is it's a little bit more of a conservative makeup than the S&P 500, all right? Has less tech stocks in it, but you can see that, there's not, it just depends on the time frame. So that's really one of the things that you need to keep in mind when somebody says, well, what's better, the S&P 500 or the Dow? The next question in your mind should be, well, under what time frame, right? Short term, long term, what are we talking about? Because the answer to the question as to which is the best, even best performing, will really be dictated by the time frame. And let me just go ahead and back this up so you can see what I'm talking about. If we go clear back as far as my data will allow me with these two ETFs, in this case, I can go back to the 4th of January, 1999. Okay, so we're looking at 21 years or so of data. You can see that over that time period, the Dow, in this case, is up 368.21%, and the DIA is the ETF on that, and the S&P 500 is up 300.68%. So in this case, there's about a 68% differential in favor of the Dow. But again, I hope you're understanding when you're doing analysis like this, you have to be open-minded to other considerations other than just absolute performance over a specific time period. Okay, because again, as we shorten up this time period, we get back into this new secular bull market that we're in. Then you really start to see, right? If we go back again, just to kind of refresh your memory, kind of recap this. If we go back and we get into March 9th of 09, let me back that up so we get to that exact date, and you can see that there is a performance differential in favor of, get my data set exactly where it's supposed to be. There is a performance differential in favor of the S&P 500. Okay, so guys, a lot of it has to do with what you prefer working with. Again, I think most people, and the data suggests that the assets under management, the trading volume, are in favor of the SPY, the SPY, which is the largest ETF and the most highly traded ETF for the S&P 500 index. Okay, so if you're really up in arms, again, I'm not here to give you specific advice. I'm here to educate you. You could use both if you want. There's really not going to be an advantage to using both. You're probably just going to complicate your trading. But you can see from a performance standpoint, guys, they're so similar. But let's go ahead and pull this back in. And as a matter of fact, let's just go back to this past year. And again, you can see the S&P is up 26%. 26.23%. The Dow is up 19.35%. And when I start to drag this back, so we're going to keep the 1 year setting on this, and I'm just going to go back. So we're looking at 1 year rolling periods going in reverse now. Okay, so I'm going reverse chronological order, and you can see that they go back and forth. All right, back and forth, back and forth, back and forth, and so you can see it right there, right? Look at there's times right back in 15 and 16, which were kind of tough periods in the market, pretty sideways. That's when the more conservative investment, in this case, the Dow Jones Industrial Average, the DIA, outperformed by about 3.5 percentage points, up 1288 on the S&P 500 during this time frame from December of 15 through December of 16, versus the Dow being up 16.3. All right, so I hope this isn't too boring, and again, stay with me because there's a lot of good stuff coming, but I just want you to understand, and because it's really important, right? When you're an investor, it's really important to understand these types of things, and I don't think most people know this stuff, all right? So once you understand this, then you're going to know that you can pick one or the other, or if you're in one, for instance, if you're in the S&P 500 and we're in more of a volatile period and you see that the Dow is outperforming, don't be surprised by that. You should almost really expect it, right? Because we know that the Dow is a little bit more conservative. Hence the reason when you're in a secular bull market, And especially when technology and things like that are, Microsoft and Google and Apple and Facebook and all these tech stocks are really outperforming the overall market as they have been for the last, 5 to 10 years, you should expect that the S&P 500, which has a higher exposure to those types of stocks, is going to outperform the Dow. The opposite is going to happen, though, when we get into a rougher period, more volatility, or when we get into a bear market. And I'll back this up so you can see this, that in a bear, by the way, a correction is when stocks fall 10% from their previous high. A bear market is when stocks fall 20% from their previous high. That's all that stuff means, okay? Correction, 10% or more drop, bear market in any sector, stock, overall stock market. It applies across the board. So a stock itself can be in a bear market, even if the whole stock market's in a bull market. If a stock falls 20% or more from its all-time high, then the talking heads on CNBC, Bloomberg, Fox News, whatever, they're going to be saying, "Oh, this stock's in a bear market." That's all that means. Okay, it just means it's down 20% or more from its most recent all-time high. All right, so let's back this up. And again, you're going to see that the performance, is going to swap back and forth. Now, here's a period where the market was negative. So we're looking 28th of January of 2015 through the 28th of January of 2016. And S&P 500 was negative 3.56% via the SPY during that time frame. And the Dow was down slightly more, down 4.38%. All right. So there are times, right? I said that in, a lot of cases, the Dow won't go down as much, but that's not always the case. It just depends, right? But you can see that, these things are pretty similar. But for most people, the S&P 500 is going to give you more diversification. So to that degree, it may be the better choice for a lot of people. But again, you have to make up your own mind about this. So here's one of those time frames I was talking about. So here's August of 08 through August of 09. And we can see that the S&P is down 18.45. Again, the SPY is, which is the S&P 500 plus the dividends being reinvested. And by the way, guys, and I've got a whole nother video I just shot on this, so go out to my YouTube channel and check it out. It's really a very good, very informative video where I looked at 7 different S&P 500 investments, 3 different ETFs, 4 different mutual funds, did a lot of analysis on that. It's a phenomenal video, if I may say so myself. So please take a look at that. But the point I was going to make here is that you can't invest directly in the S&P 500 index. So a lot of people don't realize that. You can't invest directly in the Dow either, okay? You can invest in products that replicate or attempt to replicate, in this case, these 2 ETFs, the SPY and the DIA. But these are just the 2 investments that I chose to do this analysis with today for this video for you. But the other thing to remember is when you're looking at the performance data of the price performance data of the S&P 500, for example, if you're just looking at the index itself, not this ETF, that index is not going to show the reinvestment of dividends. And there's, generally 2.25% yield on the S&P 500. So the SPY is a total return product, which is going to reinvest those dividends. So you're going to see a slightly better performance number over most time frames using and looking at the analysis using the SPY an example versus the index itself. But again, for more information on that, just go out and check out my other video. Okay, so again, we can see here that the S&P 500 during this time frame, again, down from the end of August of 08 through the end of August of 09, it was down 18.45%, and the Dow was down 16.19. And that's what I was talking about. And a lot of times when we look at the drawdown, the Dow in a lot of cases won't go down as much as the S&P 500, okay? And again, it's just the construction of those different investment vehicles. But you can see, and again, I'm backing up. You can see that, they'll swap back and forth as to which one is the better performer but it just depends on the time frame, okay? And so, again, the question you need to ask yourself when you're doing analysis, when people are saying, well, what's the better investment? It depends. It depends on, on how the stock market is actually acting. But I hope you can also see, as we're going through this video, that directionally directionally, these things are generally going in the same direction at the same time, okay? And so as I draw this back out again, we're clear back in January of 1999 now. And as I pull this forward to go in another direction, right, we're going to go towards towards the current time frame. You can see that these mirror each other pretty closely directionally, right? Directionally. You can see that the S&P 500, we already know, has a slight performance advantage over a longer period of time, but directionally, well, at least in bull markets, but here on this one. So as I said that, when we go clear back to 1999, in this case, the Dow, right, has actually outperformed the S&P 500, okay? But when we pull this forward, so that's another thing to keep in mind. I don't think I showed you guys this view yet, is because of these drawdowns, right? Because of, the 2000 through 02 into 03 bear market, but, multi-year bear market, which doesn't happen very often at all, where you get multiple back-to-back-to-back negative years in the stock market. It's super rare. And then we had that 2007 where we kind of started, breaking at the end of 07 into the beginning of 09. When you get this type of drawdown, it's going to favor, and generally when you're comparing two investments over 20-some years of data like we are here, a lot of times you're going to see that the more conservative of the two investments will have the better performance, total return performance over the longer time period. But how many people are actually going to buy one thing and hold it for 20-some years? So again, I think we have to match our analysis and our conclusions to more real-world scenarios than just buying something and holding it forever, which for most people is not a realistic situation. So as we start to shorten up this data and we get into this new secular, again, hope I taught you guys a new word, long-term trend, secular bull market, we will see here that the data favors the, I'm trying to back this up and it's not cooperating. The data is going to favor the S&P 500, okay? So now we've got March 9th of 09 to current, and again, the slight outperformance advantage to the S&P 500, okay? So we've kind of beaten this to death. I hope you've enjoyed that. But guys, I've got something else really special for you. If you really want an advantage in your trading and investing, and if you're looking for answers, if you're looking for something that can really help you, if you're looking for something that can help you know when to step on the gas, so to speak, and then also step on the brakes, as I alluded to when I opened the video, I am the president of Simple Market Signals, and I've spent 20 plus years in financial services. I've been trading and investing in stocks and options, investing in mutual funds, trading and investing in ETFs. ETFs obviously newer, right, because they haven't been around as long, but since the early 90s is when I started really actively trading stocks and options. And so I have a lot of experience. And for my own personal trading and investing, even though I'm really good at technical analysis, there was still some things missing. And I would do all the stock research and buy a stock only to have the whole market go down and take my stock with it. And even though I knew I did a lot of really good fundamental analysis, and even with my experiences, even with, at the peak of my financial services career, I had 4 securities licenses, life accident and health license, 5 industry designations. And there was still a hole, right? There was a hole in a void in the knowledge. And I've worked with mutual fund managers, and I've known a lot of these guys that were really, really smart. And I still, and talk with them, and there was still a void for me, okay? So bottom line here is spent over 20 years doing research, studying technical analysis, fundamental analysis, and trying to figure out in reverse engineering how the stock market really, really works, because I needed to know for myself. The bottom line is I was able to create a model, and it finally came together in 2017. And I call this model Simple Market Signals. And after I started working with this model for my own personal trading and investing in 2017. I realized how special it was. And I'm a businessman. I'm an entrepreneur, right? And I started looking at this and I'm like, man, I've got something really special here. And there's a lot of people that can really benefit from this. So I built a business around this model, and it's called Simple Market Signals. Let me show you what it does. So let's go back to 2018, okay? And the signals are either green, yellow, and red. And if you understand how to drive a car, you understand the basic premise of, green means go, red means stop, yellow means caution, right? So it's just the way it works. So if you see a green light, probably not a lot of danger. Something could happen, but you're probably safer, right? It's the lowest risk reward signal out there, right? It's you're going to have your highest reward per unit of risk taken on a green signal. With the yellow signal, that's where it's kind of you're in the interim period, right? It could be a transition from green to red, or it could just go green, yellow, green again, okay, as you'll see. But the bottom line is, just think about it like a stoplight. Green means go, yellow means caution, red means stop. So going back to 2018, remember the model finally came together for me in 2017. So this is real world data, and the signal was green and this is just calendar year 2018 we're looking at here, and then the signal went yellow right here. Now, to make this easy to explain, I combined the yellow and red signals, and then just separated out over most time frames, just to make it easier for you guys to understand this. So the yellow and reds are combined here, and so we went into the first part of the year, almost the full month of January of 2018. The signal was green. The signal on the S&P 500 went yellow towards the end of January there, and then you can see here that we had a choppy kind of sideways to slightly down price action. We had a very short green signal, and that happens, right? This is a very, very short signal, but it does happen. It's just the nature of the model. But it went green, and then you can see here that it went yellow again, and then went back to green again here, and then green, and then yellow and red. Now, the way I designed this for myself, and there's no right or wrong ways to use this, okay? But the way I designed this for myself is I'm fully invested when the signal is green, and then I'm generally in cash when the signal is yellow and red, because I know that it's really going to be hard to make money in a yellow or red signal environment, okay? And so as aggressive as I am as an investor, and, I ride motorcycles, I've got a Corvette. I mean, I'm kind of risk really doesn't bother me. But at the same time, I understand how to take risks, when to take risks, right? And you have to be a master at what you do, okay? And just to give you an example, all right, since I mentioned motorcycles, I have 6 motorcycles. I've been riding for over 50 years. Been riding since I was a little kid. And when I go out and ride, I'm fully dressed in a full face helmet, Kevlar gloves. I've got, depending on the type of bike, I'm either wearing leathers or, I'm wearing an abrasion suit. Okay. So the point is, it's balancing risk and reward. And that's what I'm all about. Okay. It's my personality. I don't mind taking risks, but I don't want to take unnecessary risks. All right. Because risk is where the reward is, guys. If you don't take any risk in life, you don't get any rewards. Okay. And so a lot of you might be listening to this and go, oh, man, that guy's a knucklehead. He rides motorcycles. Well, it makes me feel alive. I was like that ever since I was 6 years old and got on my first motorcycle. It's just, a mini bike and stuff. It's just the way I am. All right. And trading and investing makes me feel alive as well. But I hate losing money. So if you're like me and you're looking for something that will give you an advantage, and by the way, guys, I probably priced this way too low. It's dirt cheap. Stay with me. I'll get to that in a second here. But any of you listen to this, watching this video can afford this. Trust me, just stay with me on this. So let's get into 2019 and see what this looked like. So we came into 2019 and the signal was still red. Now, the first thing I want you to understand is this model, again, it's somewhat conservative in nature, okay, because it's designed to help minimize risk while at the same time maximizing return. So it will help you in both bearish situations, so you'll be able to know to take less risk when the when the risk reward ratio is out of your favor during a yellow or red signal. Conversely, when the signal is green, and by the way, I want to make sure I touch on this before I finish that point. The model is based on the stock market itself. The model is not based on opinions, forecasts, news headlines, politics, or lagging economic data. So even my own personal opinions don't come into this. This is a fixed, structured, multi-factor model that is based on the U.S. stock market. That's why it works so well, okay? You can look at time frames like this last bull market we're in since middle of October, kind of jumping the gun here a little bit, but look at all the stuff that's happened, man. We've had, impeachment of a president, we've had coronavirus and all this stuff, and the stock market is on an absolute tear. So, my point here, guys, is news headlines, politics, and they don't really. You cannot trade and invest that way. You have to use something like this. And by the way, this is a proprietary model. I am the only person on the planet, 7.6 billion people on the planet. I am the only person on the planet with this model, okay? And I'm glad to share my data with you. I'll get to that point here in a second, because again, any of you watching this can afford this. So as we came into 2019, the market bottomed and started to go up. The first thing I want you to understand, the model is not going to pick the exact bottom, okay? Don't expect that. The model will not pick the exact bottom of the market. But over time, in the aggregate, you will win, and I'll show you. So the signal went back to green here, and you can see that the market rose. And by the way, in case I haven't said this already, what I have found in working with this model now for close to 3 years is that the stock market will only really rise, make its significant movements to the upside when the signal is green, okay? Because again, I'm looking and measuring at multi-data points of the U.S. stock market. There's influence of the bond market on there. There's numerous things that play into this model, okay? And it's because the simple market signals is based on risk reduction, and these are risk signals. When the signal is green, that means there's the lowest amount of risk in the U.S. stock market. When it goes to yellow, that means risk is starting to rise, okay? And then when it's red, that means that the indicators in the model all agree, and this is the most dangerous time to be an equity investor. That's when the signal is red. Now, again, sometimes these signals don't last very long, but that's the way this model works. So again, you can see here, we had a yellow signal back into a green, we had a yellow back into green, we had another yellow back into green, and then we had a super short, and this is 2019 again. We had a really short, this is the shortest signal I've had in this model since it came together in 2017. It was a 3-day signal, and it happened during the first part of December, where we went from green to yellow and then back into green. The other thing I want you to understand, because it's just a reality of the model, is there are times that, for instance, if you're only investing in the green periods, which is pretty much the way I use this, okay? So I'm invested in the green periods, I'm in cash, I'm invested, I'm in cash. So yes, it does increase your trading, no doubt about it, okay? So you'll have to figure out, you don't have to use it this way, but this is the way I use it. This is the way I designed it. But at least you'll know that this is where you're probably going to make most progress, and then you're going to have a little pullback. You're going to make the most progress when it's green, all right? It's going to be hard to make upward progress when it's yellow. But there are times when you're going to sell out. For instance, here, if you sold on this yellow signal and you bought here, you actually bought in at a slightly higher price, and that was the point I was getting to, okay? That is just the reality of using a loss mitigation system to make sure that you keep your profits and your principal intact. It is super important, folks. Whether you're going to use my system or do something on your own, you need a strategy to cut losses, okay? The basic premise of being a successful investor, a successful trader, is to cut your losers and let your winners run. I'm going to repeat that. Cut your losers and let your winners run, okay? Don't fall in love with stocks. Don't fall in love with the stock market, right? It's not going to love you back. It's about making money. It's about math. And to me, with the way I'm wired, the way I've always been across my life, right? The motorcycles and everything else I've done, racing, motocross and drag racing and all the crazy stuff I've done, and I'm still here, right? Knock on wood. It's about risk mitigation. You can take some risks in life, and you should take risks in life because that's where living is really at. But you should minimize your chances of getting hurt, okay? Through preparation, through expertise in whatever your field is. You don't just go hog wild and throw caution to the wind. That's when you get hurt, okay? So let me go back here. Now, the last 2 years that I've shown you here, 2018 and 2019, that's real world data. Now, what I did is I went back and I back tested this in 2007, that when, you know, the market that it started to go down in 2007, to see what would have happened if I would have had this in place during the 07 through beginning of 09 downturn. And so at the intersection here on the upper left-hand side of this chart, you can see here that the signal would have, and again, this is back testing, but this is using the exact model, just going back now that I know what I have here, now that, you know, this is all in place, the signal would have went red, and these are weekly bars where the previous chart was daily, but I just wanted to get more data on here so you could see it. But the signal would have went red at around 1500 on the S&P 500 in November of 07. Now think about that. November of 07, the signal would have went red. And again, if you're like me and you don't invest in red periods because you know that that's your worst risk-reward ratio signal, I'm in cash, okay? And again, if you want to work with me, you'll have to figure out how you want to use this, but that's the way I designed it. That's the way I use it. Again, it's always up to you. But so the signal would have went red there, and then now this does happen, okay? The market tries to rally, and then we got a green signal right here, and you can see where that arrow is pointing, and you can see where my cursor is, and then a week later, it failed. So that happens, guys. That happens in real world. You get a rally attempt and the rally fails. Now, when that happens within the model, it's called a whipsaw, okay? A whipsaw. And so, you know, you got whipped out, all right? But the point is, take small losses, don't take big losses. So yes, if you were using this system and if you bought on the green signal, a week later, you would have gotten an email from me that said, hey, the signal went red. You get, you know, and then you would have probably gotten back out, okay, if you're using the system the way, you know, that I use it. So you would have taken a small loss here. But look at this. Then the market fell quicker and quicker, bottomed, and then started to come back up. And then in the end of April, right towards the beginning of May, the signal went green again. But we did not get another green signal for that entire time frame, okay? So you would have been able to sit out, hypothetically, depending on how you want to use this, you would have been able to sit in cash and avoid that entire downturn, and you would have been able to buy back in. If you would have gotten in right around in here, you would have been able to buy back in on the S&P 500 somewhere around the 875 level on the S&P 500. So, folks, and I've got videos out on my YouTube channel. I would encourage you to watch all my videos because I pack them full of information. But I've got videos out there that explain why, from a mathematical standpoint, you cannot afford to take big losses, okay? So, so go out and watch those. But again, you could have sold out somewhere around 1,500, and then you would have had a small whipsaw there, a small loss perhaps. You would have been able to buy back in at around the 875 level on the S&P. And so I'm hoping you're seeing the beauty of this system, okay? Now, if you're interested, if you like what I've said, what you need to do is go out to my website, simplemarketsignals.com. And guys, it's a weekly email. It's $19.95 per month. It's less than $5 per week. And on a 30-day calendar month, it's less than 67 cents a day. And I hope I've proven through the course of this video and the other videos that you may watch my knowledge level, my desire to help people, okay? This stuff works, and I want to help you, okay? I'm a former financial advisor. I'm a former vice president and regional sales manager for Oppenheimer Funds. I love this stuff. I love helping people. I want you to win. And there wasn't anything out there like this, so I had to develop Simple Market Signals for myself. But again, once I had this, once I started working with it, I'm like, man, I finally found it. I finally figured this out. I finally have a system that helps me know, irrespective of headlines and economic data and everything else, when the signal is green, ignore all the rest of that stuff. There's not a lot of risk in the market. The market's probably going to continue to go up when the signal is green. There's no guarantee, of course, but when the signal is green, you have to trust it. When the signal is yellow, you at least may want to take some profits, Okay, and if you're if you like asset allocation and portfolio, if you're a long-term investor, then you can use the signal to just rebalance your portfolio and take some profits, right, that you made during a green signal. And then if you're a contrarian investor, another way to use this, right, is when the signal is red, maybe if you're a really long-term investor and you're a contrarian and you're a deep discount value type person rather than a momentum type trader, then make the bulk of your new purchases when the signal is red. So to go back here, I mean, if somebody from a long-term perspective would have, invested, if you have a 10, 20-year time horizon, you don't care about the short term, and some people are wired that way, all right, then, and they'll ignore the short-term fluctuations. Then, you would want to make the bulk of your purchases in this area when the market is red, because over time, you're putting money to work at lower and lower valuations, right? When price to earnings ratios are compressed, and then over time, it would generally work in your favor. So that's another way to use my signals, is to make the bulk of your purchases when the market is in the red zone. Okay. So again, go out to Simple Market Signals. First thing you're going to have to do is accept the cookies. It's just standard these days. And then you click here to get started. It'll take 4 or 5 minutes is all, literally 5 minutes or less to get signed up. You'll need your credit card, of course, and an email address, because I do email the newsletter out on the weekend. If a signal changes in the middle of the week, I do what's called a special midweek update. So if there is a major signal change during the middle of the week, I will not wait until the end of the week to send you that data. I want you to have this information as soon as possible so that you can benefit to the fullest. And guys, I don't know what else to tell you. I hope you've enjoyed this video. I hope you'll work with me. Again, it's $19.95 a month. There's no contracts. You can cancel at any time, and your first 2 weeks are free. Okay, your first 2 weeks are free. So, try it out for a few months. If you don't like it, cancel your subscription, right? But it's a $19.95 per month investment in you, in your success, in your ability to understand the market at a level that very few people can. Okay, so again, thanks for being on the video. Please subscribe to my YouTube channel. Give me a thumbs up. And tell your friends and family members and colleagues about Simple Market Signals and my YouTube channel. And I'll see you on the next video.